longer I do this, the less and less I even look at something that's nearing 100 years old. One of the biggest allures of build to rent is the fact that you know what you're getting. It's new, it's updated. You're going to be able to attract the A-class tenants in your area. Keep it really simple. Meet the largest demographic you can meet within your town. Provide a good place at a reasonable price that you're not going to be pushing the market. You're not going to have to lower your standards. Yeah, I think one of the challenges as investors right now, as we all feel it, is we're getting squeezed. Properties across the board are appreciating at the fastest rate in a 5-year span in the history. And at the same time, especially right now, we're getting crushed by rising costs. So we have rising interest rates, we have rising property taxes, we have rising insurance premiums, especially in particular areas around the country that have been hit very hard. But then we're also those same properties, especially if you're looking at a 2-unit, 3-unit, 4-unit, 5-unit, they have a lot of deferred maintenance. They're older. They're probably at least in my market, most of the units like that are trading at a reasonable price are early 1900s or maybe even mid 1900s, but certainly not 1970, 1980, 1990, or 2000. Those units are trading at very high prices that don't make sense financially as investors. So I think one of the biggest allures of build to rent is the fact that you know what you're getting. It's new, it's updated. You're going to be able to attract the A-class tenants in your area. You're going to be able to disrupt and undercut those older units and older investors that may have let their properties go for a long period of time just expecting to collect. So I think that's one of the biggest allures, at least for myself.
Yeah, I agree. And I would just add to all that is just the supply of properties has also 100%. Been lower. As a real estate, and by the way, just so people know, you're in the Michigan, and but across the country, like the amount of properties on the market that investors can even go buy or regular homeowners can buy has shrunk as well. So I'm really intrigued. And one of the things I want to talk to you about that you're actually adding housing to the market. You're one of those investors. We call them the small and mighty investors who's actually building more houses, both to sell to other people and also to rent. And so I want us to give some examples, what you're doing, what I'm doing. But before we even get there, like I want to hear some people to understand your background, because I mean, you're building houses, you're doing all this stuff, but like, how did you even get into that? If somebody's like saying, I don't think I can do this building like these guys are doing.
I still think of myself as that person. I invested in my first property in 2013. I lost every penny on it. I think maybe on the last podcast I was with you on, we kind of ran into that, but my tenant got murdered. The property got broken into. They stole everything, all the copper, all the wiring, everything. And I lost my entire life savings, which was everything to me at that period of time. And I had to kind of rebound. I had to reshape myself. I had to invest in myself and understand, what this game really meant. And then they got back to square one, which is slow and mighty, and just build something, one house at a time over a period of years. And I didn't inherit any money. Wasn't given any money. I never had any high paying jobs in that time frame. But it was just one at a time, and it was consistency, and it was believing in what you talked about in this book, even when things were crazy, and we can get into some of that stuff, but I'll never forget like the 2015, the first time I really experienced like super ultra negative news cycle while I'm flipping a house, and Robert Kiyosaki was calling it the everything crash, and that, before the 2016 election, that the world was going to implode and it was going to be 10 times greater than the 2008 crash. And
I've heard that story like 7 times since then.
Yeah. I'm sitting there like, man, I'm gonna be holding the bag on this flip, and what am I going to do? And what would happen? And it's fun. I chuckle when I think about it, because it was a live-in flip. And, worst case scenario was I was just paying the mortgage and living there like every other American. I started there, and that's where I think of myself. And that's what I really want to kind of relate back to. I know we're doing some really cool things now, and we have a real estate brokerage, and we're partners in titles and the construction stuff and the flipping stuff and the holding stuff. And we have a few different businesses and stuff.
Well, thank you. And I'm going to link, by the way, to our first interview, because I think your story, I know it's inspiring. And to me, like the thing I like to look at in anybody, and yours is a perfect example, is how somebody responds when things go badly, when it's hard. And real estate's not always easy. Like I don't try to fluff it up either, and I know you don't either, but it's got a ton of upside. And we're going to be talking about new construction today and how that's a kind of a current strategy. But the biggest investment is like the psychology of, can I get knocked down and get back up, and also being humble about where you're coming from. So you're very knowledgeable, and you have a interest both as a builder on big projects, but you're also a small and mighty investor, as you were just talking about. You've been building building wealth one house at a time, build, and now you're actually building properties. So I wonder if you could just talk about, like, kind of take a step back even from building, like, what do you look for in rental properties? Like, so if you're going to build supply to do this, like, what do you personally with your investment portfolio, like, what's a good deal look like?
So it's changed over time. 11, 12 years ago, it was kind of okay. The first house was the cheapest house I could possibly find. And that strategy wasn't the right strategy. You have to look at value. So I had to change my whole context. And that took a long time because I had a lot of the Dave Ramsey in me of like, cheap, which is perfectly good. And then I had to listen to a lot more of like the Robert Kiyosaki stuff, or at least for a long time, I'd always think of myself as the person in between, like the Dave Ramsey practical approach and the Robert Kiyosaki of kind of more of like the, everything will go right approach or whatever. And I had to kind of marry the two things. So I had to look at true value. And so value back then was in the suburbs, and you could still, everything worked. And even back then you could maybe even get close to 2% rule on a good quality area.
And explain what that would mean. So you'd buy a house for 100,000 or for 50,000 and rent for 1,000 or something.
Yeah,
like
something
that.
like that, right? Or if you get a duplex or a triplex, maybe you get it for 130 and you could rent it for, 22, 23, 24, 2,500 a month. Those deals were possible back then. Now it's not possible. So basically around COVID, we moved from all of our portfolio being in the suburbs and in good areas, and we still have basically all those properties. And we started targeting new areas, new up and coming areas, not, kind of the yesterday C- that just graduated to maybe C, and then now they're emerging into C+ areas, or at the very minimum, they're solid C areas. And that's primarily where we invest right now, almost exclusively. One particular pocket that was definitely yesterday C- that is kind of teetering on getting, closer to C+. We have bought quite a bit in that area, commercial apartments, duplex apartments. We bought a salon in there. And so we've just kind of strategically bought quite a bit in that particular area. But it's a little bit different than it was, a few years ago. And it's going to change going into the future too. But
so you have these existing older rentals, and when you say A, B, C, just that my understanding of that is like A is the most expensive location, B is like a little bit close to that, but still a lot of owners, whereas C is maybe more blue collar, a little bit lower rent, and C- versus C+. And so you're investing a little bit lower price. Are you also building houses in those areas, or do you try to find a different location?
Yeah, my new niche now over the last couple of years is 1-bedroom apartments. Probably it's almost closing on 3 years, but I love the 1-bedroom demographic. I love that no one else likes them because everyone likes the bigger numbers. If you get a 2 or 3 bed apartment, they're going to rent for much higher. In my opinion, it comes with a lot more turnover, a lot less affordability and turnover because of that. And then also challenges with, just keeping those people and getting really good people and well qualified and all that sort of things. So we've been buying up, all sorts of different 1-bedrooms. We did a motel conversion, into traditional 1-bedrooms, but that's our niche demographic, and I love it. So what we're building, right now is 1-bedroom apartments, and to me, it makes all the sense in the world. There's different areas that we're doing it in, but yeah, I love that kind of demographic.
Yeah, I like it too. I'm in a college town in Clemson, and it's a lot of the new construction comes in and they do build 2, 3, 4 bedrooms. But we've found a little niche of buying studio or 1-bedroom apartments, and they're our easiest to rent typically. This kind of evolves over time, but we find people who don't want to have roommates and don't want to have to, it's just more affordable, like you said. So that I like that niche too.
And they stay a long time. And probably our biggest client is the older individual or potential couple that probably just owned or may have just owned. They look around and they look at how costly affordability to own is, even if it's a condo, and then you have a $200, $300, $400 condo HOA fee for maintenance versus, so all of ours have tiled walk-in showers for the most part. Those sort of things, regardless of the demographic, brand new, updated, all that. And, they can rent one of our places for $850, something like that a month, which is way more affordable. And we have quality places. So yeah, I love the demographic of the 1-beds, high quality 1-beds at affordable rates.
Perfect. Yeah, you're one of my coaches in rental property mastery, and a lot of what we talk about there, when I'm analyzing a deal, I always say there's 2 parts of it. There's the location and kind of the buy box, which you've just been describing. Like, I have 1-bedroom apartments. Here's the price range. Here's the type of people who rent my properties. Like, I just want people to understand that how detailed you understand your buy box there. The other part of that, though, I would love to hear from you is just rough numbers. Like, we could get into deal analysis all day long, but like, what is for a good deal if it costs you X amount, what would a property probably need to rent for it to make sense for you as a good investment?
So for me, like this particular area has been neglected for a long time. So most of the deals we buy need a lot of improvement, and anything that we're going to own is going to look appealing from the outside. It's going to have our, brand behind it, and it's going to beat our competitors. So like this particular town, all the large apartment complexes have been in the same family for decades. That means boiler systems. That means inefficient, high energy bills and all that sort of thing. And so for us, we want to redo all of that. So the numbers are a little bit skewed because we come in, we put tens of thousands into each property and whatever. But at the end of the day, my target is I want a stable asset that we can get long-term fixed rate financing on, and that, we have our capital back out of the project. So some of them are smaller, some of them are larger, as far as dollar amounts. But that's really like at the core of it. That's what our main philosophy is. We want a long-term stable asset that holds up under pressure if we have to decrease rents, but also, we can get our capital out and move it on to the next project.
Got it. So, for example, if a unit rents for $850 or let's use
Mm-hmm.
$1,000 a month, you would want that one unit to have the rent minus your expenses like taxes, insurance, maintenance,
Mm-hmm.
management. You'd want to have enough cash flow from there to pay your long-term mortgage and still be able to refinance it and get all your money back out.
And cash flow, yeah. So our most of ours go from 715 to 850. That's really our window that we stick to for the last couple of years. So if anything we buy, that's our target. So my stress test is, okay, if I can feel really comfortable of dropping that to 600 a month, and maybe cash flow goes away, or maybe cash flow is really minimum, but we can still maintain that and not have any worry. That's my benchmark. The challenge always in it, it's probably across the country, certainly in this state and our county, is property taxes. That's the greatest, I think, oftentimes probably most overlooked aspect of a deal as well, because I think a lot of people don't want to really believe where taxes are actually going to go to. But property taxes are going to double or triple when you buy some of these properties, almost guaranteed, because they've been owned for so long. And so that's a great eater of cash flow. So we're going to go on the Michigan State Treasury property tax estimator. We're going to plug in, where we feel the assessing department's going to put us at. We're going to take that number. Sometimes it's lower, usually it's around that number. At the end of the day, we're going to just stress test everything and make sure that we can drop rents to a spot that we know we can take the top tenants still, even if we have a compression in rental property rates. So that's really how we stress test and make sure we're comfortable. But we do want to get our capital out.
Got it. That helps. So you stress test the rent, you make sure your payments and cash flow could survive having to drop rents.
Mm-hmm.
And then on the other side, so whether you build a unit or whether you buy an existing unit and remodel,
Mm-hmm.
it's sort of the same analysis, I would assume. It's like,
for sure.
What kind of cost? And I know every deal is a little different because the property taxes might be different. But if you had a property that rents for $800 per unit, what would be a typical per unit cost that you would need to be in to make those kind of numbers work that you're talking about?
Depends. So for our new builds, usually it kind of depends. I mean, so if we're building like a 4-unit, which we are right now, we're going to be about just under 62,000 a unit build costs typically, and that's going to be super basic. That's going to be on a slab. That's going to be basic, decent material and stuff, but basic. And it's going to be with, the contractors we have a great reputation with, which is going to be a challenge for a lot of people. You have to start somewhere. You have to start where I started, 12 years ago. And so it's not going to happen overnight, but, we have great relationships with people. We know our pricing to do it. And we've done over the years, many, many full guts. So, the only difference was when we started to do this was, okay, what does it cost to get the site prep? What does it cost to do all the engineering work? And then what does it cost to do the foundation and frame the house? Because beyond that, we already know our costs really well, right? So that was, so that's kind of, in this demographic, this is, like I said, a C market. No one else is really building here. So for the most part, it's just us. And I really like it because it's one of I think it's the thoroughbred working class town of my county. And I think it's a lot of, I know the people really well just because we spent a lot of years trying to figure everything out. And I think it's good people. They stay, they love the community. It probably doesn't look like much to the majority of people that may look at the town, but I really know the demographic. And we we steal and undercut all of the grade A tenants from the majority of the buildings because we're priced right. We have a far superior product. We think of our clients. Our 10 unit, we provide free Wi-Fi to all of our tenants. We just try to go the extra mile with anything we do to make sure we get the top tenants. And we have several six-figure earners living in our apartments that's at $715 a month, and they love it. It's a great product, and so that's really our niche. Is we just want to undercut our competitors. We want to provide a superior product, and we want to have stability and no turnover. For the most part, we have very little turnover.
Yeah, it's really impressive because it's sort of the best of both worlds. Like in some ways, you want to have the best brand, you want to have the best finished amenities, you want to have the most comfortable place. And yours are the simple, nice, safe amenities. But you're also going back to the cost side of things. You're getting into deals that allow you to keep your costs low for the tenant too. So that then they look around the competitive landscape. They're like, all right, I could go one town over with new construction rentals that are going to cost me twice this, and I can live there and pay a lot more money, or I can just stay here. And so you're grabbing the good credit tenants, the best tenants, and you're giving them a better product at a better price. Like that's a good business model. Part of what I want to get to was kind of comparing our different strategies of building new construction, and I have a lot of existing rentals too. And I love that you're invested in the community. I'm the same way. Like I feel like Clemson, where I live, like is one and the same for me. Like I invest here, but I live here. I love it. I'm doing a nonprofit in the community. So to me, that this is what real estate investing is all about. But in order for you to be a competitive advantage, like you're talking about, let's go back to like the nitty gritty, maybe of a deal, and you choose any deal you want, or you can just talk about like just the basics. But like in order to build that property at 60, you have a really low cost structure. Some people are not going to be at that cost structure, which is fine. But if you're going to rent a place for $800, or in my case, I'm trying to rent houses for $1,900, single family houses, and I'm trying to build them all in for maybe like, including land and everything, like $240,000 somewhere in there. So like, I think I just want to start with this rent to price ratio, because this is how we can kind of compare market to market. Like you're in a market, in a C market with new construction rentals, that kind of working class, that you're trying to be in it for $60,000 or so on an $800 rental. I'm trying to be in mine for about, a little bit higher basis, but in a little bit, B neighborhood, 240 for, for a $1,900 rental. So let's talk about like how you source a property like that. How do you even start with that?
So for us, I work for a builder as well. I have for several years, and all around this community, the new build rentals are going for $2,200 to $3,500, and there are several communities we've been involved in some of those too. I could build the same square footage basically and divide it up between 4 people and have affordable housing, in 1-bedroom demographic. And that's why I choose to do kind of the 1-bedroom 4 units, because I don't love the turnover of a 22 to 25 to a rental that I see a lot of these other communities have, because it's just difficult. It's a high price tag, especially in my market. In other markets, it's a reasonable price tag. And you want to do numbers on something like that?
Well, I would just say, like, so that's good to know. Like, number one, you could build a $2,200, $2,400 rental that's like a 3 or 4 bedroom. Instead, you're saying my model is like a 1 bedroom that's going to be a lower price. So how do you think about? Let's start with this, like the location. Like, so how do you find a piece of land that you're going to build that property on that still kind of gets the whole thing started?
Multifamily zoning is difficult, and different states have different zoning regulations. But in my area, it's impossible to find a reasonably priced multifamily zone piece of property. There are very few to begin with. And then secondly, if there is that zoning, someone had the forethought many years ago to hold it and know the value at some point. So the price tag is very high. So you either have to do one of two things. You have to go into C-class areas where they are seeking more affordability, which will mean you'll have to lower your rent costs. So you have to figure out the pricing structure to meet that, like I do. Or you have to probably have a higher ticket item in a higher area. So you just got to figure out your strategy within building. And I would love to have those kind of conversations directly with people, depending on where they're at, and kind of finagle through what that looks like. Because we have done, and I don't think I mentioned this, but we built last year high-end condos in one of the premier suburbs of my county. We did a large apartment complex build. So we did, we've done some of those things and hit some of those higher price points. But for me personally, when my wife and I are thinking about this, it's how can we provide affordable housing in area we like, which is this particular working class town, and keep it affordable for that demographic and keep them there long term. Because I don't want to create a job for myself. My 3 bedrooms in the suburbs, they turn over a lot, right? It has to be a higher ticket. I'm paying higher taxes and everything else. And the turnover to me just drives me crazy, of every year, every other year, even with great tenants, they move on, they want to buy a house, rightfully so. The one bedroom demographic for me, it hits the niche. Even if they turn over, it's a very easy, simple demographic, and they take care of the property, from my experience, a lot better. So that's really where I look at. Okay, how can I provide really good, affordable housing at a reasonable price and carry that on to the customer?
Got it. So the town you're looking in, there are lots that you can find, or do you
There
have
are
to
lots,
convert other stuff?
there are a lot of commercial lots, and so getting commercial zoning and turning it to multifamily is pretty isn't that challenging of a conversion. Getting a residential lot and converting it to multifamily, that can be really tricky, especially if you're going in decent areas. You can have uproar from the neighbors, right?
Yeah, they'll bring the pitchforks out soon. If you mentioned multifamily zoning in a
100%.
single family area,
100%. And I've witnessed it, and I've semi been a part of it, and it is very, very tricky. So you have to understand what you're really asking the community, and what community are you asking. And so for us, we target a particular road, which is the main vein through this community that has commercial zoning, and I'm not going to get a whole lot of blowback because that's a pretty similar classification. So we do have to go in and get multifamily, but it's already zoned commercial, and we don't get a whole lot of blowback.
Sounds like you're repurposing, like you're taking an older neighborhood or older place that has either a lot that used to be something else, or this is a building that used to be something else. Like the hotel is a good example. And you're like, all right, I could see a new vision by repurposing this property, either blading it and just tearing it down, or using the shell of the property. Is that accurate?
For sure. 100%.
Okay.
Yeah. You have to also, as an investor, you have to, at least at some point, you have to acquire the skill of being able to put yourself in the position of the local government. I'll never be the first one to defend local governments or county governments or whatever. But at the same point, you have to understand what it is that they want, what their constituents want, right? Because what we as investors want may contradict what the constituents at large may want for a community, or how their envision of the community. So you really have to, if you're going to be a great, effective builder, or a build to rent, or even not a builder, but just work with a builder and build a community, you have to sit down and kind of think to yourself, what do they want? Look at the master plan, look at the future master plan. Where are they wanting these types of things to go? Where is the overlap between where the local planning commission wants these sort of things to go to where is a lot that may fit within that demographic? That may mean going in and having conversations with supervisors, which I do all the time, of townships or cities, or maybe going and talking to the planning commission, maybe going and talking to the building administrator, whatever that may mean, to be able to get a better grasp and feel of your area, what may be available. And then for me, that's my first step, is going to talk to them. The second step is, okay, let's look at some lots that correlate to that region that I'm looking at. Most of them probably aren't going to be for sale. So it's going to take some legwork, whether you or a realtor or broker or whatever that might mean, reaching out to some of these people that may have it and having those kind of conversations and finding a spot that meets your needs, meets the city or township or whatever that may mean desires, and then also meets your building criteria.
Yeah, you're not fighting uphill. I guess one of the hardest things to do is to try to get a variance or a rezoning that's against the flow or the momentum of the town. Like you can try to do that, but it's like it's not easy to do. So what you're doing is you're looking for where the areas are already wanting to do multifamily or small multifamily, whatever you're trying to do, and then you start there. Then you go do the legwork of saying, all right, here's 5 or 10 lots that I could try to reach out to. Or in my case, I'll just throw out some other ideas. Like I'm looking at a property right now that's a single family house, but it's a little bit smaller residential zoning. Mm-hmm. So instead of like a 20,000 square foot lot, you can have, I believe it's 12,500. That's not super small, but 12,500 square foot lots. And so I'm looking for lots that are kind of oversized, that maybe we can divide that lot into 2 lots. Mm-hmm. And so you can just multiply. If it's over 25,000 square feet, then, which is what, it's a little bit over half acre or so, then there's still other criteria there, but that's kind of part of my criteria for searching is oversized lots that have road frontage where I can do a sewer tap, relatively flat lot. Mm-hmm. So that's just an example too. Like you work it backwards from what the zoning allows, and then you look for that.
And that's another cost. I'm glad you brought that up, that you have to think. So as a sort of developer, even a really small developer that's probably, most of the people listening are probably going to hire a builder. So that'll be a whole nother conversation on what that might look like. But as a sort of small developer, the things you have to look at is, okay, what does the municipality want? Is there current zoning? Likely there probably isn't going to be a whole lot of lots that have multifamily zoning, but there's going to be opportunity to build within something that has it. Maybe you do have, there's a lot of different things. Maybe they're commercial, but having those conversations. And then secondly, really understanding the pre-build costs, which I think most people don't see. So sewer taps, water taps, site prep, engineering work, what the water and waste department charges, because you're probably going to want to independently meter for water if you're going to build a 2-unit or a 3-unit or 4-unit or bigger. So all those sort of costs up front prior to even putting a shovel in the ground. What is that bulk? Talking to foundation companies, talking to framers, or maybe you hire a builder, whatever, and they have their fixed cost per square foot. Perfect. But a lot of times outside of that cost to build is going to be all these site prep and pre-build costs.
Yeah, a lot of, I don't know what they call it in your area. A lot of builders around here call that the soft cost of the deal. It's like before you start paying people to put up the framing and the roof and all that stuff, you have these soft costs, which are basically permits and sewer taps. And I'm actually looking at a different property right now, and the raw land is there. The zoning is supposedly there, but there's just a lot of unknowns about water runoff and retention issues. And so there's just like a laundry list of things. And I think you could almost think about like flipping a house. Like you have to flip this land from the raw land to the like finished lot. And there's a whole set of things you got to do.
One thing you have to really get really comfortable with and understanding up front is value of a piece of land. I think it's easy to fall back into what I fell into with my first property, which is, what's the cheapest lot I can buy versus what's the true value of what's being offered. You talked about water runoff. That's probably one of the most crucial things you're going to want to do. If you're thinking about doing this and you start to look at different lots available, the next monsoon of a rainstorm you get in your community, I'm sitting out there across the street from that lot just checking it out. That's what I do whenever I'm buying some. I wait for a big rainstorm. Right now is a great time in Michigan to have a lot of those. And I go sit there and I figure out where the runoff is. In fact, there was a lot I was about to buy a month or two ago. I was considering it and it was inexpensive. And this guy was selling me on why I should buy it, the owner and all this kind of stuff. And I owned a rental property, basically around the corner. And I said, all right. I said, I'll get back to you in a week or two. I got some things going on. And, we had this big rainstorm coming up, but, at least it was supposed to. So I go there across the street. That lot, within 30 minutes of it starting to downpour, literally had 2, 3, 4 inches of water sitting on it. 30 minutes after the rainstorm, it had all dissipated. But I couldn't believe how much water was on that lot. He didn't have the curbs cut in. Talking to the road commission and talking to, someone that could do that. I mean, that's a big expense, relatively speaking. And so all these costs, kept adding up. That one was a really cheap lot. And then you look at down the street, something going for 2 or 3 times that, and you go, man, that's a lot more. But then, okay, curbs are already cut in. It's a great standing lot. It's at the top of the kind of where everything starts to go downhill towards this particular lot. So you have watershed. This is on the side of where the water and sewer lines are, not across the street like this one is. So all these kind of additional expenses that you may not immediately think of that you're going to have to start to train yourself to start to think of and look at. And it's not going to be readily available. There's not like one app that you could just go and figure out all these things. You have to get really good at figuring out, okay, where's the sewer and water map? How do I locate that? Where's the zone? Where's the master plan? Where can I find that? Usually you could just Google master plan X city, wherever you're in, and you'll be able to, figure that out easily. But you're gonna have to train yourself to look at these different things to start to look at a lot's true value, not just what it's trading for.
So I'm going to pause here for a moment because a lot of people are going to hear all that. And I know maybe I did the first time I heard it. I'm like, that's really intimidating that I have to figure out all these costs. And the price of the lot's not just the price of a lot. I've got all these other things. How am I ever going to figure that out? And what I'm going to say to all of you, if you just hear this kind of thing for the first time and you're interested in building houses to rent or properties to rent, is that's a competitive advantage that Bradley or I or other people who are buying these have. Like, knowledge is your competitive advantage. So how do you go to school on that? There's no like book in school that says, how do you figure out the cost of a lot in Clemson, South Carolina? You have to go and you have to talk to the city people, the city utility departments. You could take notes though, and you can learn about it. When I'm in the mode, I'm literally like not super experienced in this right now either, but I'm interested in building. So I'm like in the learning phase. I'm asking my friends who are builders or people that I meet, I'm saying, how do I figure out the cost of this lot? Like, why is that cost a lot more than this? And you just have to dig in and learn these things. So it is learnable, right? You could do it, but it's not overnight.
Here's a challenge for me to a lot of listeners, and kind of on theme with everything that you represent, Chad, and what I've always related to. The reality is, we're in April of 25. We're recording this, and a lot of the other podcasts or gurus are going to say, hey, build to rent. Let's do this. You can do it right now. The reality is, you're not going to do it this year if you haven't already put some of these things in motion, most likely. And it's going to be a learning process. You're going to have to take it one step at a time, and it's probably going to be a year goal. It's probably going to be a next spring goal, to do something like this, unless you're in a position to buy something after a builder's already started something or whatever. But it takes time to build, it takes time to prep. You don't want to rush these things through, but starting to train yourself. There's so many resources online. You could Google checklist of a small developer or something. I'm sure you could get, we could probably even provide something after the show on kind of a checklist on what to think of. Starting to looking at the master plan in the city. Most investors I've found that are entry level, which is a great place to be. Like even myself 10 years ago, I would have never thought to just Google master plan my town, whatever town it is, and start to get familiar with that. And why are they doing it? Going to sit down with the supervisor, going to sit down with the building inspector. Why do they create the zoning maps the way that they create them? And sometimes it can feel frustrating, like they're trying to limit, but really probably at its core, it probably was designed by somebody with the best of intentions of the town to maximize how we do it. So how do we operate within that and bring value to our community or a neighboring community or a long distance community or whatever to the best of our ability. So taking the time to start to really fully understand that, meeting with people, reading a book, looking through checklists, going on and figuring out where the water and sewer map location is, and then, printing that off. I mean, I used to do that all the time. I'd print it off, I'd enlarge it, go to a shop and get a large laminated poster of the water and sewer lines, and I would drive around and start to just note where water and sewer was in my community. I started doing that like 6-7 years ago, way before any of this. And I would just, okay, man, why it stops at that road? Why does it stop at that road? It's interesting, and then I started to realize, okay, no wonder why the lots on this street bordering up to where the water and sewer stop are more expensive than the lots, half a mile in the same school district and the same zip code and the same everything else are going for, because, it costs you 40-50 grand to put in well and septic, which is perfectly fine. But most people want to be right there in there. Tap fees are $7,500 a piece in my area. So 15 grand and you're tapped in there and you don't have to worry about well and septic and all that. So just starting to train yourself, it takes time. It's not going to be something, if you're thinking about this for the first time, that's going to happen tomorrow, or nor do you want it to. You want to be able to get really good at it, talk to the right people. Like you said, talk to builders, start to look at plans. There are a lot of great resources online where you can buy some basic, if you really want to kind of do some initial digging and getting price packages and stuff, you can buy some simple floor plans online from, reputable architects that have some really simplistic basic plans, and you can go to lumber yards, you can get some pricing and that sort of thing, and really start to play around with what that may look like.
Yeah. So to get people started, I love all those ideas. We will do a checklist that we'll have after available. So if you go to coachcarson.com/BTR checklist, so BT, the letter T, R checklist. And we'll have a link below in the podcast and YouTube description as well. So that'll get you started. But I use Chat GPT a lot too lately. One of the ideas that I'm kind of enjoying in my own town is I'll get the master plan for the community. I'll get all the zoning regulations. I'll get the budget for the town. I'll put the latest news, and I'll just upload all that to Chat GPT and say, I want to have a conversation with you about, I had this lot, I want to develop it. Tell me, based on the rules on this lot, the zoning on this lot, what do I need to be thinking about based on the rules? And then it's just a brainstorm. Before I even talk to the zoning people, and then I go to I'll ask ChatGPT, what's a list of questions I should ask the zoning person about this lot, and then you call them up. So that's something recently I've been doing a lot of. But that checklist will kind of tell you what you don't know, just be thinking about what you should be asking.
Absolutely.
Before we leave the lot, though, do you have a rule of thumb on pricing lots? Like, is there like a percentage of the final value of the building? Is there a percentage of the cost? Like, how do you think about lot costs?
It's difficult to answer that question, but even in my own county, I get that kind of question a lot. I'm very connected with builders all around our county and otherwise. And I would love to have those kind of conversations on specific areas and stuff, but it's challenging because even the suburbs versus the, working class town where I'm like, it's just dramatically different, even the percentage of it. Is there development costs? Like if you're doing a a 4-unit, what's the size of the parking lot that they're going to require? How many parking spaces? Is there catch basins and all these sort of things that they may require you that may cost a significant amount of money that you need to think about. I don't know if there's like a rule of thumb percentage per se. It could depend, right? Like if you're trying to build a 8 to 20 or plus unit complex, you may be able to, pay substantially more upfront versus if you're trying to do a duplex and it has to be really small, and it's all ratio of kind of where you're landing, I guess. And it's difficult. I don't know if I have a rule of thumb, but.
Okay, that's good. No, I just curious.
And plus, like, are the curbs cut in? Is the water and sewer on your side of the road? Is there already some infrastructure there, and are my costs minimal, and that sort of thing as well?
I think part of the problem is comparing apples to apples. Like what you're saying is like somebody might say, "Here's a lot you can buy," but it's not clear that that's an actual padded out buildable lot.
Right.
Like you probably have a lot of other costs, but it's accurate to say, I would say, that the cost of the lot plus the cost of your construction has to meet some threshold that we talked about earlier. So for you, if you're shooting for 60,000 per unit, because that's the amount that the rent will support in order to cash flow it, then you have to work it backwards and say, all right, my build costs are going to be this. My lot costs can't be any more than this. Right.
Yeah,
so there's always some working it backwards of saying, here's where I want to be in order to have a good deal in real estate investing. And that's probably kind of the big picture of this whole episode is like, you want to own rental properties, whether you construct them, whether you buy them existing, whether you fix them up. You got to start with that end and say, when I total up everything I got, this is where I got to be. There's some people listening to this, and some of our best students in RPM have been people who've been on like they have a full-time job. They're an attorney, they're a doctor, they're an engineer, they're a teacher or whatever. They have like $100,000 capital saved up. And they're like, I've got 3 to 4 hours a week. And so they're attracted to build to rent because they can go to a builder, developer. And this is actually what Ariel and Shihai does a lot. He sells to clients like this. He had a builder build a duplex. It might be like a $525,000 purchase price in a good area of Dallas or Austin. And then the rents are $2,200 per unit. So it's like $4,600, $4,300 per in rent on a $525,000 purchase. Now that's not the same numbers that you're looking at, or maybe I'm looking at as the entrepreneur, but somebody can justify that, say, I'm going to put a larger down payment. I'm going to hold it for the long run. I'm going to get a fixed interest loan. I'm going to have the builder often buys down the interest rate to, 3.9% or 4.5% because there's some incentive structure. So like, I guess the point I'm trying to make is everything we're talking about here just depends on the role you're in and what your strategy is. And so there's lots of ways to make it work.
If I buy a 1950s or early 1900s duplex or fourplex, what is that trading for right now? And what's the percentage higher that I'm going to be in for building? And I think there's number one, we talked about, you're servicing your community. That's what I appreciate most about being in this industry is like, I feel like I'm actually adding to the community, not just extracting. Because in a lot of ways, when you buy a duplex, I love it, I do it. But in a lot of ways, you're just kind of extracting from what's already there. Right. And we try to do that at a high level and provide a great service and all that. But when you actually build a duplex, you're adding to the community, and you now have the best unit in that town, most likely, or at least one of the best units in that town. It's going to be attractive for somebody. And on the tax side of the equation, our CPA loves, when we do this, what we can do as far as cost segregation and bonus depreciation, all this kind of stuff. So there's value there, but we really have to figure out, okay, what's the cost to purchase an existing one? What's the cost to build one? The longer I do this, the less and less I even look at something that's nearing 100 years old, because there's just so many problems with that long-term. I'm a long-term guy. I know you are too. Even if I do short-term stuff, which I occasionally do, I never buy something with a short-term horizon. It's always something that I would keep long-term. In fact, I sold our very first rental a couple weeks ago. We had no intention of selling it. It happened to play itself out that way. But everything we buy is, with the intention of long term, and if we sell, we sell.
Yeah, I like that thinking too. I did a YouTube series a while back where I supervised fixing up a 105-year-old triplex in our town. It was educational for me, even after 20 years in the business, where I was over budget, like way over budget. It was during COVID. It was just like kind of a laundry list of like comedy of errors on my part too, forgetting stuff. But to me, it also just showed the difficulty and the professionalism you have to have and be on top of remodeling old buildings. Like there's just a bunch of gotchas. So, I think, we don't have a ton of time to talk about this one,
Yeah.
but I would like to give your feedback. So we get a lot. We're trying to get to the finish line of having a build to rent property. Do you have just any insights on like common issues or mistakes maybe on the construction side of things, like either as you as the builder who's kind of supervising it, or maybe just as the investor who's hiring a builder to build it for them?
Most people always overbuild, in my opinion. Too nice to finishes, too large, whatever, because costs really start to stack up. If you look at, I have a spreadsheet and you may have 75 columns of real costs, and then you may have 15 or 25 of soft costs, and small numbers add up when you multiply it by something like that, right? And so what I almost always find locally is people overbuild, and so I really think that you need to go minimalistic, know who your end consumer is, and you need to know what your real cost numbers are too, which includes property taxes, which is the number one cost of the property besides your P&I. And so you really need to get comfortable with that and then work backwards of, okay, what am I going to sell this for? And am I pushing the rental market, which I don't ever like to be at personally. I understand the model. I understand there are a lot of people there, but I don't like to push the market. I like to
You
be really
don't want to have to, you don't want to raise rents in order to make the deal work, is what you're saying.
raise rents and then lower.
Mhm.
And then usually when you raise rents, you have to lower your standards,
Yeah.
typically speaking. So I don't like to be there. I like to have good criteria, good people, and have a quality product at the same time. It's just my personal, because you get yourself into situations and you have to get this price and you only have 3 people and it's been a month you've been trying to market it. I mean, you have a $2,500 a month rental. Let's say that, the average market in yours is $2,000, right? So you're pushing the market by 18% or whatever, 17, 18%.
Yeah.
And, so you have a few different people and they all have these different things and this story of why and everything else. And it's been 30 days and you're like, man, I don't want to go another month with, interest only payments before I get to convert to this. Banks tell me, I have 45-day rate lock, if I'm going to convert this to a full term, but I need a lease to get it and all these kind of things that we all deal with. Well, I'll just put them in there. This will work out for this year. Next year, I'll deal with, whatever. And then a few things happen. Either they trash the place, they don't pay you up the victim, and then they trash the place or whatever. And, you had to lower your standards just to meet the, situation. Simple for your first one. If you want to get elegant and everything else down the road and that's your model, go for it. But keep it really simple. Meet the largest demographic you can meet within your town. Provide a good place at a reasonable price that you're not going to be pushing the market. You're not going to have to lower your standards. That'd be what I have to say on that one. Yeah.
Yeah. Good advice. So final question I wanted to ask you about constructing. We've talked about the lot. We've talked about development, a lot of the gotchas there. You talked about some of your advice here with building. To get the money to do this, and this is another big topic, but what's a typical scenario for you to actually fund the lot purchase, the construction, getting it all the way to that permanent financing where you actually refinance it? Like, what's that look like in your world to have all those costs paid for?
I just prefer private money, pretty much anything I do on the acquisition of anything. So, but there are a lot of different new construction products. I'm familiar with a lot of them. I'm very good friends and close with pretty much all the major players in that, whether they're banks or brokers. But there's definitely, depending on your situation, some banks that have appetites for 10 or 15% down. There are some things like that as long as you purchase a lot. They want to stay ahead of schedule, but so they'll have their own criteria. But usually it's 20 or 25% down. Different criteria. Usually the 10 to 15 is like a commercial type portfolio loan that they may have trust with you and you're a be bankable sprint, which is fantastic to kind of get yourself to that position. But usually it's more of like a commercial variable rate type product. But there's a lot of different products to get it done. I would suggest talking to whoever you're closest with. If you already bank with a regional or local bank, I would have a conversation with them.
Bradley, the thing I love about our conversations is, man, it is so nitty gritty. Like we get into the weeds, which I love. Like to me, the fun part about my job as a podcaster and also working in RPM is getting to talk to you, to other investors, and just having fun on the details. Like this is a detail business, and you do it better than anybody else I know. You're into the weeds, into the details, on a lot of different parts of real estate. So if people wanted to stay in touch with you, Bradley, connect with you offline, how would they do that? How would they connect with you afterwards?
My email is bradley@soldbylabrie.com. We can add that probably to the notes. If somebody wanted to email and reach out, I'd love to do that. You could go to soldbylabrie.com, which is my website, which would also have my information, or Facebook is Bradley Labrie or Instagram Bradley Labrie, and I'd love to reach out, stay connected, and dive further on something specific. And like I said, it's gonna be a process. If this is something that you're not super familiar with, I would not advise necessarily, going and jumping in tomorrow unless you
Yeah.
have the free capital and you have a builder that maybe already in progress or something like that. But it's really going to take some time to understand and chat with people and get familiar with things. And it's a long-term game for sure.
Bradley, this has been awesome. Really appreciate you, friend. And we'll talk soon.
Sounds great, Chad. I appreciate it.
All right. Thanks, Bradley. In this episode, we talked about how build to rent can be a really smart path for investors. But I also mentioned how remodeling my 103-year-old triplex was one of the hardest and most expensive lessons I've ever had. What I didn't share was exactly what went wrong on that remodel project. So in my next video, I walk you through the 3 budget-busting mistakes that I made, and I also show you the after video of the finished kitchen, the cabinets, the flooring, and I also show you footage of the finished interior with cabinets, trim, new sheetrock. If you're watching on YouTube, just click on the thumbnail above me here, or you can click on the link in the podcast or the YouTube description below. I'll see you in the next episode.